You're never far away from conspiracy in the gold market, and not all conspiracies are false. And in markets, one needs to keep an open mind to stay solvent. The recent influx of gold and silver into Comex warehouses in the United States has led to speculation that the U.S. is on verge of revaluing its reputed considerable stock of gold, valued at $42 an ounce, to the market price currently approaching $3,000 an ounce. It's a theory that can't be completely discounted with disruptor-in-chief Donald Trump in charge. But what if something bigger is afoot? There's a long-held belief in the gold market that one day the U.S. will revalue their more than 8,133 tons of gold it's reputed to have. I say reputed, as another long-standing rumor is that the U.S. does not, in fact, have all the gold it states, with the last partial audit having been in 1974. The gold in Fort Knox and the other U.S. depositories is valued at $42.22 per ounce. At that price, it's worth only $11 billion. But revaluing it at today's price of around $2,900 would make it worth over $750 billion. Handy if you're wanting some starting capital for a sovereign wealth fund. How a revaluation would work, the theory goes, is that the U.S. would import and bid up gold ahead of the price change through the largest bullion banks. It would then announce it's marking its gold at the new price. At the same time or before, the government would announce by fiat that all Comex futures contracts would be cash settled at a lower price, as there wouldn't be enough gold bullion to meet physical delivery to the long contracts outstanding. The U.S. has formed here, confiscating gold from private ownership in 1933. As paper gold holders would find out with merciless rapidity, right at the moment when you need your gold, you can't get it. As said at the top, the U.S. going down this route is only a tail risk, but one that's marginally more likely with Donald Trump at the White House. There are already several things he has done and said that were probably not on many people's presidential bingo card. Regardless, changes in the gold market bear close scrutiny, as they are reflective of the major and ongoing shifts seen in the geopolitical tectonic plates over the past few years. These words were written yesterday, February 13, 2025, by Simon White, Bloomberg macro strategist. You may recall that during the first Trump administration, the then U.S. Treasury Secretary visited Fort Knox on August 21, 2017, the day of a solar eclipse. He even sent a tweet out confirming his gold reserve visit that day, quote, "Glad gold is safe." Well, in only about 2 weeks into his new role as U.S. Treasury Secretary head, Scott Bessent has already made more noise in the global gold market than Mnuchin's flyover solar eclipse visit did. Let's break this gold revaluation on the books idea down a bit further.
Here's the Trump administration is in brainstorm mode when it comes to containing the massive budget deficit. On the table, revaluing the country's gold reserves and creating 50 to 100-year bonds. Investor Peter Bookvar tackling the viability of these ideas in a note today. Explain to us the mechanics of marking to market the gold reserves and what that does for Treasury.
So in 1934, the Fed transferred their gold holdings to the Treasury and in return got this gold certificate. In 1973, that gold, which totals about 260 million ounces or 8,100-ish tons, was valued at $42. So on the books of the Treasury, right now the gold's worth about $10 billion. But in reality, with gold at around 2,900, those holdings actually total north of 800 billion. So I'm hearing chatter, and the Financial Times over the weekend in an editorial talked about the possibility that the Treasury, in a relationship with the Fed in terms of gold certificates or maybe a repo or other ways of basically injecting the difference between the current mark of 10 billion, the current old mark really of 10 billion and what would be a new mark at 800 plus billion, and that cash would get injected to the Treasury general account.
So why does gold go higher in that scenario?
Well, it at least maybe would put a floor under the price of gold. Now, what would push it higher, we'll have to see. I think there's still other factors that have been in place over the last couple of years, like voracious central bank buying and gold becoming a really important sort of clearing of reserve transactions. China, for example, having $1 trillion of surplus, well, they're less and less recycling that in U.S. Treasuries, and they're doing it in gold. I think those trends continue on, but maybe just putting a floor underneath and really just telling people about the importance of gold in this world financial system that we're currently in right now.
I think that's exactly the point. I mean, it's not necessarily that it's bullish for gold, but it just puts a spotlight on what gold means and the importance of it. And I think the bear case people say, well, that will allow them to sell it. But I don't think that's really what's going on at all. I mean, if they were to sell it today, they would reap the mark-to-market gain. So it's not really where it's valued at. It's just putting a spotlight on the importance. Can you speak to that?
They have no interest in selling gold. This is just a sort of on one hand, the criticism can be it's an accounting gimmick. It's a one-time thing. It's a one-time injection of cash. But I think the administration is looking at a variety of different things to deal with the excessive debts and deficits we have. I mean, Scott Bessent, when he said he's focused on the long end, he was not kidding. He's looking at many different things to keep the 10-year sort of in check and not to see a retest of 5. Because if you blow through that, you're talking 5.5 and 6. He wants no part of that. So they're looking at a lot of different ways of trying to avoid it.
And speaking of long end, I mean, in your note, you're talking about an even longer end, a 50 or 100-year bond. That idea was floated in the first Trump administration, never happened. What are you hearing now in terms of existing bond holders, Treasury holders, being able to swap out for a theoretical longer-term bond?
Yeah, so this would not be sort of your standard Treasury issuance. Let's sell 50 to 100-year bonds because we know the liquidity there, as seen with the 20-year, is pretty thin. This is something, again, trying to be creative on their part about swapping or trying to convince foreign holders of Treasuries to swap some of these holdings for 50 or 100-year Treasuries. That they would have limited ability to sell. The Fed would then create a potential facility allowing them to pledge that if they wanted to repo it. But the Financial Times article talked about this and sort of strong-arming some of our foreign friends and their holdings to take this 50 or 100-year paper. Again, another brainstorming exercise trying to term out our debt and even make it zero coupon so they don't have to pay an interest expense on it. Of some of the things in dealing with the financial situation that we're currently in right now.
This U.S. gold revaluation on the books accounting move has been done before. James Rickards points out that in 1973 it was done. Gold revaluation increased book value by about $2 billion at the time. That one-time, quote, write-up was transferred to the Treasury General Fund, TGF, and spent. Treasury stated its use was to reduce the deficit. No physical gold was sold. It was an accounting entry converted into fiscal spending power. Government raised the price of gold on its books from $35 to $42.22 per ounce. The, quote, writing up from this revaluation was monetized. It was treated as revenue by the U.S. Treasury and used to, quote, allegedly reduce the budget deficit. The Treasury's fiscal position updated to, quote, received around $2 billion in what is officially termed a windfall event. Let's hear from another important gold and macro commentator speaking yesterday, Luke Roman from the Forest for the Trees letter.
What is your impression? Has your narrative shifted at all with the red wave coming in from what it was?
Not really. I mean, the last couple months, really since Trump got elected, for me, it's been about two discrete time horizons, which was sort of the ensuing the first 2 to 3 months of the year. Or post, probably more apropos post inauguration, first 2 to 3 months, and then what came after. And to your point, first 2 to 3 months, I have very little conviction or visibility. It is so politicized. And the only thing we've really been harping on, I would say, is this order of operations. Essentially, anything that makes the dollar stronger is going to risk triggering this 3Q23, 3Q22 in trading regime of dollar up, gold up, everything else down. And so
wrecking ball. Yeah,
the wrecking ball. And so it really is. The first 2 to 3 months, the lack of visibility is around. I just don't know what they're going to do now. Beyond 3 months, to me, it is crystal clear they're going to take steps to make sure the dollar is weaker. I don't think a ton weaker, but weaker. And I think we then get into a potential Goldilocks scenario if done right, where you weaken the dollar meaningfully. Perhaps they use
Right.
gold to help reduce the debt load. You do some Doge, you do some reshoring investment, and you could end up with, I think, a world later this year that shouldn't be able to exist, according to a lot of the correlations we've all come up under, which is to say, I think there's a world where in 6 to 9 months we could have $3,500 gold, we could have 4 to 4.5% 10-year Treasury, we could have $70 oil, we could have DXY at 102, 104. And I think you probably have NASDAQ actually slightly lower. And I think you have the industrials significantly higher. And that's actually a really good world. That's a really good world for investing. But it's a world that I don't think a lot of people, historically, that list couldn't exist together. But I think that's where we end up in some way, shape, or form. And I think the release valve in all of it is the dollar. At the end of the day, like, there's a lot there. They're threading a needle, but to me, sort of the blunt instruments, if I'm them wanting to try to achieve all this, I'm doing two things. Every day, I'm bidding gold. Every day, I want gold up another 10 to 20 points. Every day. Maybe one day a week, I take it off, let it back off a bit just to kind of keep traders honest. Every day, though, gold's got to go up. And then similarly, I want to keep the dollar under under 109, but better, under 105, under one, and if I can do those two things, it could work. It's going to be threading the needle. It's going to be like Maverick in the movie Top Gun Maverick, threading the valley, but it's doable.
So if there's a big correction in the gold market, is that a sign or a signal that they're off course and they're causing damage? So I mean, if we saw 2,400 in gold over the next 6 months, would that mean
if gold goes to 2,400 and stays there like that, they're telling you hell's coming, that they've screwed up, the dollar's going high. It's the old Sherlock Holmes statement is something I'm referring to as well, which is once you eliminate the impossible, anything else, whatever remains, however improbable, must be the truth. And so then you say, okay, well, we're not going to let ourselves not be able to produce weapons because they're all made in China. Okay, so we're not going to default on the debt nominally. We're not going to, and once you start cutting out, once you start cutting out all the things there's no way we're going to do, what you're left with is, I think, your dollar view, which is like, okay, the release valve has to be the dollar. And then how do we get the dollar down? Well, one way to do that is to keep gold bid. If gold just keeps going up every day, I think that at the very worst, I think that keeps a lid on the dollar, and I think it puts a gentle downward pressure on the dollar. If you just come in every day as a trader, like, God, gold's up another 10, 20 points, up another 10, 20 points, up another 10, and that gives you that leeway. And oh, by the way, it doesn't exactly hurt the U.S. if we wake up and gold's at 4,000 in November, because now if we still haven't revalued the gold, now it's $1.2 trillion, $1.3 trillion that goes into the TGA, and now you don't need to issue any duration for the next 12 months, 18 months. And that's basically gold QE into the midterms.
Okay. Wow. I feel caught up.
The gold revaluation hypothesis potentially comes in stages of eventual large national restructuring agreements. A bigger idea that revolves around a potential future Mar-a-Lago Accord for a more dramatic revaluation of gold versus outstanding fiat currency supplies amongst the G8, Russia, and China, with the largest global leaders and heads of state at said accord. An idea that could be necessary to back the new long-term treasury securities the current administration is aiming for. This revaluation could see the price of gold skyrocket to well in 5 figures per troy ounce levels. The reattachment of gold to the dollar and other major currency units would provide a more stable foundation for the U.S. currency and could help restore confidence in the global financial system at large. The current global gold supply delivery rush delays, stockouts, or shortages, however you want to describe them, is a critical factor in this equation. With central banks and investors alike scrambling for physical gold, The demand is far outstripping current supplies at the artificially suppressed for decades relative gold valuations. This current shortage fiasco is driving up gold prices and investor interest globally and creating a sense of urgency among nations to secure their gold reserves now, not later. A coming gold Mar-a-Lago Accord could be seen as a preemptive move to secure the U.S. position in a world where gold is once again a crucial asset, while coming to terms with the largest economies in a new, more multilateral economic order. You might be hearing this and thinking it's all nonsense, speculation, gold pump, or hopium. But allow me to remind you that the last time the London gold pool rig was on the cusp of falling apart, a former Federal Reserve Governor, John Exeter, drew this inverse pyramid, illustrating that for the market to clear and come back into a sense of better balance, it would lead to a run on gold. Drawn in 1968, the same year London's gold price rigging gold pool fell apart, the spot gold price went on a 24x multiple in price in the following 12 years, and silver ran a 38 multiple by the early 1980s as well. Now, this time around, it's not merely a Western world phenomenon as it was in the 1970s. This time, it's global. And I will show you more examples of that this week on the other side of this break. But the bottom line is, the current system and geopolitical power dynamics are unstable. To bring economic tectonic plate stability back, it will require a global consensus and large nation bloc agreements, likely bringing gold bullion re-rated back up sharply in relative valuations versus all the myriad mushroom clouds of overvalued asset classes at the moment. Well, the other option is further instability, violence, and sheer collective global market forces bringing about gold's inevitable revaluation higher in a likely more disorderly way. I suppose the choice is ours. We'll be right back. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
What's better than an ounce of free silver? How about 500? Get ready for another monster-sized giveaway with the SD Bullion Monster Box Sweepstakes, featuring 500 of SD Bullion's very own Silver Tree of Life coins in a monster box. This highly detailed piece of silver is a beautiful addition to any collection, and it features a hidden inscription on one of the tree branches that changes every year. So don't miss out on this exciting silver giveaway from SD Bullion, because someone has to win it, and it might just be you. Click the link below for your chance to win.
The spot silver and gold markets in fiat US dollars popped into fresh higher ranges, but settling sideways mainly for the week, with sell-offs to close today's trading. Keep an eye out on this coming Monday President's Day holiday with US Comex markets closed. Check out how gold and silver trade overnight in Asia on Sunday and Monday evenings. The spot silver market finished the week slightly up at $32.13 an ounce. Yesterday, overnight, it seems levered silver longs on the SHFE, the Shanghai Futures Exchange, did move silver upwards to a 13-year nominal price high level at about $33.40 an ounce intra-week high. The spot gold price hit a new nominal price high spike early in the week, closing at $2,882 an ounce. The spot gold silver ratio finally rolled over a bit, piercing into 87, but closed the week at 89. Silver bulls were of course disappointed by the sell-off in silver today during Comex hours. But the shorts days are numbered, giving all the fundamentals flying constantly in their face now. We're still perched well high at a spot gold-silver ratio higher than the highest high reached during the 2008 global financial crisis when everyone thought the banks were going to collapse. The coming room to cascade downward is still gigantic and long, coming out of the highest spot GSR ever reached on record outside of the Great Depression in 1933, the one that we reached during the COVID 2020 crash in the 120s. Typically, when markets overshoot in one direction, they do so again in the opposite direction with enough time and patience. Well, I'm silver bullion betting big time on that axiom. As for the other side of the gold-silver buying world, given the massive high premium payoff sucking sound in the last few months, pulling available gold and silver bullion inventories onshore into the USA's Comex warehouses. Places like Korea are having bullion supply shortages. You likely know that retail bullion demand in the USA is currently at multi-year low levels, with premiums at razor-thin levels across the vast array of bullion product offerings. In Korea, the opposite is happening. The largest retail bullion dealer in Korea has suspended both gold and silver bar offerings. Quite understandable. Their local spot price is climbing walls at the moment. The lone buyable gold bullion products I found there are in the government bullion coin variety, like these 1-ounce gold maple leaf coins currently priced at local spot plus 10% VAT plus 14% premiums above. Of course, the spot price of gold leads and eventually silver follows. Still having not yet hit its local nominal price high for silver in 2011, or the lowest priced government silver bullion coins I could find were 1-ounce Australian kangaroo mates. They're priced in 25 coins per tube at local spot plus 10% VAT plus an over 27% premium over their local silver spot price late this week. Meanwhile, here US stateside, crickets, judging by collapsing premiums on US 90% silver coinage inventories. Shameless product plug moment. Visit sdbullion.com/deals for great low premium bullion product offerings this week while supplies last. Quick gold and silver spot price check in Europe. In what to me is still the most remarkable underpriced silver story in the Western world, at least on a local level. Switzerland's local gold price is out of the barn and off to the races. Yet, of course, slow-mo silver has yet to get its track shoes on. There, the silver spot price still has to double and a half to reach its ancient 1980 nominal price high near 75. Yeah, I know. I show you these charts often. It's still crazy just how cheap silver is in many places around the developed world, especially wealthy ones per capita. Finally, a reminder that we have been seeing in gold and silver fiat US dollar spot prices to start this year. It's not normal. It's multiple standard deviations abnormal, in fact. This is gold's start to 2025 versus 5, 10, 20, and 50-year rolling averages of percentage gains throughout this full fiat currency era. Even laggard silver, in a crooked way, is off to a killer start, being dragged by its leader gold, at least for now. Now you might think, oh sure, this ain't gonna last. Well, in a bullion bull market, the surprises are typically to the upside, and for those caught sleeping short, they can literally wipe you out, insolvent, and off the market in a flash. That's going to be all for our weekly SD Bullion Market Update, and as always to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.